$800K guaranteed bonus at Goldman Sachs, but there's a clause in your contract that can cut that in half overnight. Here's why most MDs don't realize it until the money disappears. You're planning a $3M mortgage. You're telling your tax preparer to expect $800K in bonus income. You're budgeting for your kid's college fund. You're already mentally spending the $240K on the down payment. And then, in one down market quarter, you get an email. Your bonus is being clawed back by 50% due to firm equity decline. That's $400K gone. Just like that, you can't unsign a mortgage. You can't unfile your estimated tax payment. You're now $400K short and the bank is calling. Research shows this happens more than people think. The gap between guaranteed and actually paid at major investment banks is real, measurable, and almost never discussed in the hiring process. Goldman Sachs, JP Morgan, Morgan Stanley, they all have the same mechanics. The word guaranteed on your offer letter means almost nothing once you sign the employment agreement. Here's what's actually in the contract. SEC Dodd-Frank Regulation 248. 3 requires financial institutions to disclose clawback policies. Goldman Sachs, like most major banks, publishes theirs in the 10K and proxy statement, but it's buried in 40 pages of boilerplate. The key language is this: annual bonus payments may be subject to forfeiture or clawback if A, firm equity value declines by 15% or more in a fiscal year, or B, division EBITDA falls below 85% of prior year baseline. That's not might be. That's will be if those conditions trigger. And wait, there's more. There's also C, in the event of regulatory sanctions, compliance violations, or material restatements attributed to an employee's desk or division. Clawback provisions may reduce awarded compensation by 25–75%. That language is almost never mentioned during your offer call. Let's walk through the 3 scenarios that activate this trap. *** Scenario 1. Firm equity decline. *** Goldman stock drops 20% in 2024. Not unprecedented, entirely plausible. Your bonus is immediately subject to a 50% reduction on the deferred tranche. The promised $800K becomes $400K realized. Your net take-home drops from approximately $480K after taxes to $240K. That's a $240K swing in annual income. Mortgage companies see this as material. *** Scenario 2. Division underperformance. *** You're in investment banking. Deal flow collapses and a volume is down 35% industry-wide in a downturn. Your division's revenue misses by 16% against the prior year baseline. That triggers the malus clause. Your bonus is reduced before it's even paid. Some banks call this a clawback. Others call it a deferral reduction. Legally, same outcome. You banked on $800K. You realized $320K. Some peers take even larger hits. Partners in struggling divisions see $2M bonuses become $500K. ** Scenario 3. Compliance violations. ** Your team's trading desk violates compliance once. Maybe it's a documentation issue. Maybe it's a reporting lag. Firm claws back 25% of all MD bonuses in that division that year. Now your $800K is $600K. And here's the kicker: this can happen without your direct involvement. You're penalized for your desk's failure, not your own. Here's where most professionals get trapped. They model the $800K as salary equivalent for mortgage underwriting. Debt service ratio on a $3M mortgage assumes roughly $200K annual net income after taxes. Add $800K guaranteed bonus, and lenders calculate $400K additional annual capacity. You get approved for $3M based on total expected income of roughly $600K annually. But if your realized bonus is $400K, a 50% clawback, your annual income just dropped by $200K. Lenders call this a material change in financial condition. They can demand mortgage renegotiation, a higher down payment, or full re-underwriting. Some lenders will call the loan entirely. The IRS problem is worse. Publication 505 requires estimated quarterly tax payments filed by April 15, June 15, September 15, and January 15. If you estimate $800K in bonus income and file accordingly, paying roughly $280K in federal tax across 4 quarters, but only realize $400K, you've overpaid by $140K. You don't get that back until you file your 1040 in April. That's 6 months of float you didn't plan for. Here's the action: before you accept a roll or refinance debt on bonus income, request the specific contract language from benefits operations, not HR. Search for these exact phrases: clawback, malus, equity decline, division EBITDA, deferral reduction, and forfeiture. Second, model 2 scenarios in your mortgage and tax planning. 1. Full payment, and 2. 40–50% reduction. If the downside case breaks your budget, the bonus isn't safe to count as base planning income. Third, if you're already locked in, ask your bank's employment attorney to negotiate a bonus floor clause, a contractual minimum guarantee independent of firm equity performance. Your career is your largest asset. Protect it with data.